Hello and welcome. Thank you for joining our Saturday community. I don't even know what to call this anymore. It's not a podcast. It's not a seminar. It's not really a webinar, but it is a place where you can come to get information about buying a house, especially if you've never been down the path of home ownership. Here you're going to learn today we're going to talk about assets, okay? But if you jump into the chat and you ask some questions, we'll definitely answer whatever the question is about your exact scenario. But we're going to talk about assets, okay? Because when it comes to buying a house, there's three major legs to a loan, and that's income, assets, and credit, okay? So we're going to cover assets today because a lot of people are a little confused as to what they're going to need in order to buy a house. And it's much easier than you know. For some, it's difficult because saving money can be a challenge, especially in today's times where things are more expensive and gas and food and utilities and all these things that we pay for on a daily basis. It can be a challenge saving assets, but I also have an avenue for you that's going to help you with that too, and it's called down payment assistance. So let's get into it, guys. Once again, if you have questions about your scenario, about what we're talking about, just hop into the chat. I also put our phone number in the chat too, so you can reach out to us and have a one-on-one conversation about your scenario. Some people are a little shy, so they don't want to go live and talk about their scenario. So we put it there, our phone number there, so we can have a one-on-one conversation and be able to help you guys down the path of home ownership. So what are assets, okay? What exactly does a bank want to see when it comes to buying a house? So let me break it down a little bit, okay? So when it comes to assets, the only thing that must come out of your account is the required down payment, okay? The required down payment. That's the only thing that has to come from you. Now, when it comes to closing costs, which are third-party fees, those can come from the seller of the house, your real estate agent, your loan officer. It can come from a number of places, but the down payment must come from you. So let's talk about just the down payment for now, okay? So that's the assets that we're looking for. The minimum down payment for a first-time home buyer is 3%. 3%. So of whatever number you're buying on a house, whatever price you're purchasing on a house, it's 3% of that number. So for every $100,000, that's $3,000. So $200,000 house is $6,000. $300,000 house is $9,000. $400,000 house is $12,000, and on and on and on. So that's the required minimum down payment. But where do these assets come from, and where can they come from? That's a great question. Thank you for asking. So the down payment assets can come from your savings account, your checking account, any funds that you have in an account that's accessible that you can prove. So this isn't cash money underneath your mattress or that you keep in the safe at home, because that you can't prove, you can't track it, okay? So the whole name of the game here is anti-money laundering, okay? They don't want some narco drug dealer from Mexico rolling in here with a bunch of cash and buying a house with it to try to, money launder. So they want to see that the money's been established in an account of yours. What kind of an account? Well, it can be your bank account. It could be a checking, a savings, a CD. It could be your stock account. It could be your brokerage account. It can be your 401k or 403b, anything that gives you access to funds to buy a house. And a lot of your investment accounts that you have with your employers do allow you to access funds to be able to use for down payment on a home. Now, the reason why is because what you're doing is every paycheck, you're taking a little bit of money out of your account and you're putting it into an investment account. And over time, 10, 20, 30, 50 years down the road, that account grows. And then when it comes to retire, you have a big pot of money that you're able to access to live off of at the age of retirement. Now, the reason why they let you do this into a house is because 10, 20, 30, 50 years down the road, that home has appreciated value. So you're not taking money out of the account, you're reinvesting it into a different vehicle. So you buy a $500,000 house today, 10 years from now, it's worth $800,000. 20 years from now, it's worth $1.5 million. 50 years from now, it's worth $2 million. I don't know the numbers, but you can see by accessing those funds, you're putting it into a different vehicle that will grow over time. Okay. So assets. The name of the game is to be able to prove it. And a lot of people don't have those assets in their account to be able to make a transaction happen because of what I just said earlier. Life is tough. It's hard to save money. It's hard to stash it away for a rainy day or to even buy a house. I mean, a lot of people that I've worked with over the years have had to save for a long time to get to the point of purchasing a home. So what's another avenue that we can solve that with? It's called a gift. A gift. Okay. You can get a gift, and those will be your funds to use. So who can a gift come from? Friend, family member, someone who is close to you that you can prove, a significant other, your employer. So a lot of people are like, yeah, who's going to give me that kind of money? You'd be surprised. A lot of people go to their parents or loved ones, and they're able to help them. They're able to help them. And a gift means exactly that word, guys. So don't try to have any funny business when it comes to this. A gift is a gift. Just like at Christmas, you open up a gift, that is yours. They're not asking for it back. They're not asking for a payment plan for you to give it back. It is a gift. And that's what the bank has to know, is that this money is given to you. Okay. So let's go to the math again. Let's say you're buying a $300,000 house, and they're giving you the 3% down, which is $9,000. So your parents, let's just say, or brother or sister, whomever, gives you $9,000 to buy a house. Now, they have to fill out a gift letter, which means they say, I, Chris Dominguez, am gifting my sibling $9,000 to purchase this house out of this bank account number. And in some cases, they do have to provide a bank account to show that the funds are there. Not every case, but in some cases, they do have to show that. Okay. So that's another way of solving this challenge when it comes to gifts. Now, let's talk about the most popular way to close the gap when it comes to assets. And that's down payment assistance. So you need a down payment. Whether you're getting a program to help you or not, you still need a down payment, because there's entity one, which is the bank. And the bank says you need 3% down minimum to buy a house. That can come from your assets, which we discussed. That can come from a gift, which we discussed. And now the third one where it can come from is a down payment assistance program. Down payment assistance program is a third party that fulfills the guideline of the bank and gives the 3% to be able to satisfy the guideline, whether it's through a payback period. So let's talk about that $9,000 again. So is that money free? Sometimes. And when it is free, it's called a grant. And with a grant, you just have to live into the house for a specific amount of time according to that grant program for it to be forgiven. Most of the time, it's 3 years. So they give you a grant for $9,000, and that covers the down payment. So that covers that part of the assets. Okay. Now, if you live in the house for 3 years, automatically there's paperwork that's done. The money's forgiven. If you decide to sell the house, you don't have to pay it back. If you decide to refinance the house, you don't have to pay it back. That's the grant. Now, the payback programs are a little bit different. One of the most popular that I use here in California, now we have others that we use for out of state, but one of the most popular that we use here in California is called CalHFA, CalHFA. And they will give the 3% down. They'll give the 3% down, and it's satisfied that bank's guideline. And you do have to pay it back. You do have to pay it back. It's attached to a tiny little interest rate that's almost insignificant. Sorry, I got something in my eye. And at the end of your 30-year term of paying off the house, that $9,000, let's just say it's $20,000 now after 30 years, you do have to have a strategy to be able to pay that back. You can make payments inside of that 30 years. A lot of people do. They make a little bit payment here, a little bit payment there, and then it's paid off within that 30 years, so everything's paid off. A lot of people don't, though. A lot of people don't, and they do have to have a strategy to do so. So a lot of people are doing home equity lines of credit to be able to pay that off, which is very easy, simple process to do. You just need to have some sort of income and good credit and a lot of equity in your property. And if you're paid off your house, you have a ton of equity. So obtaining a home equity line of credit to satisfy that $20,000 shouldn't be a problem. Okay. You can also refinance. Lots of people do because you're going to pay it back anyways. So what happens is right now we're in an interest rate environment that we've been in for the past 3-4 years now. Okay. So what's going to happen in time is interest rates will start coming down. And historically, when rates come down, values go up. When values go down, rates go up. So it's kind of like this. So when rates go down, values are going to go up. And a lot of people are going to enter into the refinancing market. So we'll get a call saying, hey, I heard rates are now 5%. I have an 8% on my loan. I wanted to see what that payment is to refinance and see if it's a better deal. Okay, cool. So we run the numbers and we go, yeah, you're going to save $300, $400, $500 a month by refinancing, which is significant, guys. Significant. Let's run some math right now because a lot of people are like, $300 a month, that's not that big of a deal. Well, $300 a month times 12 is $3,600 a year. Okay, $3,600 a year is significant. What if I put an extra $3,600 in your hand right now? What would you do with that? What would you do? A lot of people would go on vacation. Some people would buy something nice for themselves. Some people might stash it away, but that's a lot of money. Now let's take that over 30 years. That's $108,000 that you'll be saving over the life of the loan. That's very significant, $100,000. So we're talking about a number that most people don't make in a year. You're going to be able to save over the life of the loan. So doing that refinance does make sense over the long term. That's the whole part of that rant. Now, inside of that, there's going to be a payback for that $9,000 that you borrowed for the down payment assistance. Now, you're going to refinance it inside of this loan, still save $300, $400, $500, $600 a month, and that payback has now been satisfied. So you don't have to worry about paying it in 30 years because you've done a refinance for whatever term you chose, 20, 25, 30 years. So once everything's paid back, you're done, you've complete, and you've taken the step of refinancing, which allowed you to save money in the interim, which is fantastic. So you've done a 2-for-1 in that move, which is great, helps a ton of people. It's the most popular way to solve that. Now, the environment that we're in interest rates today isn't normal. I mean, when I say not normal, I mean, we've been anticipating a rate reduction for a while now, only because that's what we've been told according to the indicators and according to the people that run things like the Fed. Telling us the interest rates are coming down for year after year after year. And they have. So I shouldn't say that they're not keeping true to their promise, but it's come down on the mortgage side way slower than it has on the other side where they've actually reduced it. Because when they do a federal rate reduction, it doesn't correlate directly to mortgages. Okay. Typically, mortgages do follow it, but it's not lockstep. So when they do a rate reduction, it doesn't mean interest rates are coming down. Sometimes when they've done a rate reduction, interest rates have actually gone up. And that's only because of the news. So depending on what the news is putting out, if the reports aren't as they want them, then interest rates can get a little volatile. They can go up, they can go down. So it just depends. It's not an absolute. So I just want to share that because a lot of people watch the news and they make moves on the news, which can be a little disturbing because you're like, yay, interest rates rate went down. And then you call me and I'm like, no, they didn't go down. They went up. And you're like, why? So I just kind of want to give you a little introduction as to how that works because I have that conversation on a daily basis. So now we've covered your own assets. We've covered getting a gift. And we've covered a third-party program for the state of California, which is the CalHFA program, where they'll give you 3% and you do have to pay it back. But what if you're out of state? Well, every state, county, city has not every, but counties across the country have their own programs, state, county, city programs where you can do down payment assistance. So we can definitely help you with that. But let me talk about one particular program that we have in-house, okay? Now, the pros and cons. Let's talk about pros and cons to these programs. The pro is they're going to help you with the assets. The pro is it's going to make it easier for you to get in providing you qualify. There's a qualifying factor to this, guys. You do have to have the correct credit score in order to get this program for them to help you with the down payment. You also need to make enough money to be able to qualify for the reduced debt to income ratio. Let me give you an example. Let's say that a traditional loan where you're paying for your own down payment, let's say you're able to qualify for $400,000, okay? And you're like, wow, that's amazing because that's how much houses cost in the area that I want to buy in. Then you go, hey, Chris, do I qualify for one of those down payment assistance programs? I really don't want to pay for the $12,000 out of my own pocket. I'd like to keep it. I'd like to use a program instead to be able to get into this $400,000 house. So I say, sure, let me see if you qualify and run the numbers. And then I get back to you and say, okay, you do qualify because you have good credit and you do qualify because you meet the guideline. And yes, they will help you with the $12,000, but now your purchase price is reduced to it's no longer 400,000. It goes down to, let's say, 290,000. And that's because they reduce the guideline on the debt to income ratio. So on a traditional, let's say it's 50% debt to income ratio where you pay for your own down payment, but now the max guideline is 45 because you're using a program. So that forces you to buy less house. Now, what also impacts that is typically these programs have a slightly higher interest rate, which means that impacts your debt to income ratio as well. So what impacts your debt to income ratio? Whatever you're paying to a bank on a monthly basis, car payments, credit card payments, installment loans, student loans, mortgage payments. So if you have a mortgage payment that has a slightly higher interest rate, it makes it real tight inside of that debt to income ratio. So now you used to qualify for a $400,000 program, but now you only qualify for $290,000. Ooh, that's where it becomes a challenge and that's where it becomes a problem. Okay. But I do have one program in-house that allows us to go with the max debt to income ratio, the max debt to income ratio. So what that means is that $400,000 purchase price, you can probably stick there. Is it going to have a slightly higher interest rate? Yes. The second thing that it has is a payback built in. So we can stay at the $400,000 range. And as long as it fits with the higher interest rate, and as long as it fits with that payback that you have per month, you can stay in that range, okay? You might get forced down a little bit. You might go to 390, maybe 385, but you're not getting pushed all the way back down to 290,000. So this program is helping those that have tight ratios, and it can be done across the nation. We can use this program in every single state because our bank is licensed in every single state. So regardless of where you're at and you're watching this, this is definitely a program that you'd want to look into if you need down payment assistance. Now, remember, guys, pros and cons. The pro is it's going to help you by giving you the assets to get in. But it's also going to come with a higher interest rate, which means that you're going to have a higher payment, a higher amount to pay back on a regular basis. And everybody is really conscious on how much money they're spending per month. So might this be the best program for you? Maybe, might it not, maybe not. I don't know. That's totally up to you to make that decision and to determine. But I'll let you know right now, if it makes the difference between you getting a house and not getting a house, I love the program. I think it works fantastic. I think it's great. Now, if you're the person who has money in your account and you just don't want to spend it, might not be the best avenue for you to go because there is going to be a payback. You're going to pay it back anyway. You're going to have a higher interest rate. And if it is one of those that is going to reduce your purchase price, it makes no sense. So if you're going to buy a house at $400,000, but it's pushing you down to $290,000 and you have the money in your account to be able to use towards down payment, it's better to stay with a traditional program. So pros and cons, guys. It's not a one and done for everyone. It is either appropriate for you or not appropriate for you. And that's how we approach finance. So there's no right or wrong, good or bad. You're going to hear that from your friends, family, those that have bought a house 30 years ago about what's good or bad, right or wrong. But in finance, there's no good, bad, right or wrong. It's either appropriate for you today or not appropriate for you today. And you're the only one that can make that determination. Okay. So now we've spoken about your own assets, gift assets, and third-party programs that can help you with down payment assistance. Now let's take it a little step further. Let's talk about the closing cost side, because when you buy a house, you have a down payment, which is one side of it, and then you have closing costs, which are the other side of it. And that total number is what needs to get paid when you close on a house. So I'll just give you some rough numbers. Let's go back to that $400,000 purchase price. Okay. Let's say that that down payment at 3% is $12,000. And closing costs are roughly about, call it $6,000. And closing costs include, if your lender has a fee, okay, it's just a one-time fee, that'll be it. But then bundled inside of closing costs are escrow fees, title fees, what they charge to be able to do the transaction. And you need these parties in order to do a transaction. Since you're borrowing money from a bank, they want to determine that the value of the house is $400,000, and they need to determine that the house is in fair enough shape to lend on, meaning there's no health hazard, water issues, water damage, termites, that type of stuff. So you need a appraisal inspection, and then you need to sit across from a notary public to make sure that you are the person that you say you are when you sign the loan docs, because those are official loan docs. So that whole amount of money is about $6,000, in that range. Okay. And then also you have to pay for your homeowner's insurance policy for 1 year. Okay. For a whole year up front. And then you need 2 months of monthly payments that you need to put in, because you're not going to have a monthly payment for a month or two. And then you're going to need property tax payments in there too. So that whole amount is somewhere between $8,000 and $12,000. So let's just call it $10,000. So your down payment is $12,000. Closing costs is $10,000. So now you need a total of $22,000 to buy a $400,000 house, which is not that bad of a deal, guys. The banks, you're going to buy a $400,000 house. Okay. 400,000 minus $22,000, because that's your down. Actually, I take that back. $400,000 minus your down payment of $12,000 leaves you with a balance of $378,000 that a bank is going to lend you. $378,000. Okay, I'm messing my math up. $388,000 is what the bank is going to lend you. Okay, that's 400,000 minus 12,000. 388,000 is what the bank's going to lend you, and all you had to do was come up with $22,000. That's it. $22,000. You bought yourself a $400,000 house. That's a pretty darn good deal for those that qualify. Remember, you need income, assets, credit in order to buy a house, and if you can make all three of those happen, a scenario like this can be yours. Now, let's say you don't have all the money to pay the $22,000. Let's say you only have the down payment, which is a very common statement that I get from borrowers. They're like, Chris, I have the $12,000. I don't have closing costs. And then we start having conversations with your agent. This is where a strong real estate agent who knows the market, understands the market, know what's available, know what's not available, is extremely important. There's so many people out there that have real estate licenses that don't practice on a daily basis, that aren't familiar with the markets, and that's probably not the best agent to work with. Now, what it means to know the market is, let's say you want to buy in a specific community, okay? Let's say it's Dolphin Cove. You absolutely have to live in Dolphin Cove because it's the safest place. It has the best school districts. It just makes the most sense for your life, and you have to live in Dolphin Cove. And Dolphin Cove is a huge community with 3,000 residents. It has its own parks, its own schools, its own, stuff. Now you get a real estate agent and you're like, hey, I want to buy in Dolphin Cove. You want to make sure that real estate agent is very familiar with that community, because you need to ask for $10,000 in closing costs. And if your agent is not familiar in that community, you might be putting offers on a house that you will never get. Because in that community, let's say there's only 2 listings, and let's say those listings are brand new, and the last listings have gotten into contract inside of 2 weeks, which means it's very low inventory, high demand, and those sellers get everything that they want when they put an offer, when they put a house for sale. Okay. And if the agent isn't aware of that and you're not aware of that, they're going to put an offer in. You're going to get your hopes up. You're going to love this house. You're going to think that, this is where me, Jimmy, Tommy, and Sandy are going to live, and we're going to raise the kids, and we're going to have Christmas here. And the truth is, you never had a chance at that house because the sellers are never going to give closing costs, ever. But let's say your agent does know this community, Dolphin Cove. They're very familiar with it. There is a couple of houses in there that have been on the market for 60 days or more, which is a long time to be on the market when you're selling a house. In some communities, it depends on where you live. 60 days could be the norm. 90 days could be the norm. I'm just giving you an example. So let's say that they're very familiar, and there's been a couple that have been sitting for longer than they should have, and she's actually toured these houses and spoken to the listing agents, and these sellers are pretty motivated. And then you go to the agent and say, I need $10,000 in closing costs, and they're like, yeah, Dolphin Cove, heck yeah, we can definitely make that happen. I actually have this exact scenario going on right now in a community in Florida. So have some buyers that are buying in Florida, spoke with the real estate agent, and I very, very skilled real estate agent, by the way. So I know a lot of agents throughout the country. Okay. So if you guys need to be partnered with a strong real estate agent, regardless of where you're at, we can definitely set you up. So I spoke to the agent, to my borrowers. So we got them qualified. They found us through social media. And when I got them, they only have so much money. This exact scenario, almost. They do need closing costs. They need $16,000 in closing costs, which is a pretty hefty amount, guys. To get 10, yeah, it's pretty normal. To get 12, yeah, you could do that. To get 16, it's possible, and we've done it in the past, but it definitely is challenging. Anyway, so I spoke to the borrowers, and I asked them, do you have a real estate agent that you know that is great, that is strong, that can negotiate? And they're like, maybe. And I said, okay, no problem. If you do, awesome to meet them. I'll work with them. Let me know. If not, I absolutely have someone in your area that you need to work with if you absolutely don't have someone that you want to choose. And they're like, Chris, introduce us to your person. So I did. So I set him up with the agent. Haven't spoken to this agent in a while. And she's more than happy to take on a new client, more than happy to negotiate closing costs. I told her the exact amount that we needed to ask for. The very next day, the agent called me back and said, hey, this is the price. It's actually $20,000, $30,000 less than what they're approved. So that's a good thing. It does have an HOA. By the way, this is the amount of insurance that's going to be charged on this property because I just financed one, or I just sold one, across the street. So this agent knows the community, like really knows the community. And then told me, by the way, we're asking for 6% in concessions. And I'm like, 6%? Like, really? And that's like $22,000. And she's like, yeah. She's like, that's the max that your loan's going to allow. The fact that she knew my guideline was amazing. And based on the days in the market, based on how these properties are moving in this community, and based how everything's ironing out, I should be able to get 6%, which means if she's able to get this, our borrower is going to come in with less cash out of pocket, a better scenario, and it's going to be a better over deal for the buyer. And it's not a bad deal for the seller either, because if this seller is really motivated and has been trying to sell their house and they just can't make it happen, it works out for both parties. But that's the difference between working with someone who knows what they're doing and someone that doesn't know what they're doing. Because this agent was able to recite my guideline, not something she asked me a question on, because most agents ask questions, but she came to me and told me my guideline specifically. And I'm like, that's amazing. I'm so happy they're working with you and that I was able to connect you guys, and that you're going to go above and beyond and ask for even more money. And where this actually is probably going to happen is she's going to ask for $22,000 and they're probably just going to give 18. Okay. There's wiggle room there. There's room to negotiate. So in that scenario, it's a win-win for all parties. Everybody gets what they want. Our borrower gets a much better deal than they knew, and it all works out. So all that being said, our number is in the chat. Give us a call, ask questions. We're more than happy to have a conversation with you on the phone. We're more than happy to have a text conversation if you're busy at work and you don't want your boss to know that we're having a conversation about buying a house. So either way, we want to help. I hope this helps with the asset side of buying a house. Watch our other videos. We cover income, we cover credit, we cover different scenarios. And if you have any questions, just reach out. Have you guys a happy Saturday, and we'll talk soon. You guys take care. Bye-bye.